This AI-generated podcast is for general information only and does not constitute financial or legal advice. Please consult a qualified professional. Welcome to the Luxembourg Fundcast, produced by Bertrand Mariaux, a regulatory lawyer qualified as Avocat à la Cour in Luxembourg and Paris. This show brings you reliable insights on Luxembourg regulations sourced from curated official references. This episode is current as of 17 May 2026.
Yeah, and it's great to be diving into this one today.
Absolutely. So I want you to imagine structuring a comprehensive cross-border financing arrangement. The commercial terms are fully agreed upon, the syndication is complete, and, the documentation is finally finalized late into the night.
Right. Classic late-night closing scenario.
Exactly. But then, say, months later, an enforcement event actually occurs. You move to execute the pledge, only to discover that the security package is totally legally disconnected from the actual exposure.
Which is an absolute nightmare.
It really is.
Yeah.
Your collateral just does not cover the specific default, and all because of a single imprecise sentence within your secured obligations clause. So, today, we are ensuring that precise point of failure does not happen to you.
Yeah, that's exactly what we need to focus on.
Right. We are structuring this deep dive strictly as a mini law class, focusing entirely on Luxembourg financial collateral. Specifically, we're examining the strict legal mechanics of drafting secured obligations clauses.
Right, because for you, whether you're independent regulatory counsel or, a financial professional managing these cross-border transactions or just a peer in the Luxembourg market, this is essentially a mandatory practical session.
Exactly. We're leaving the general commercial theory completely behind today. We're focusing relentlessly on actual legal execution under Luxembourg law.
And that focus is it's so critical because when a transaction is tested, particularly in an insolvency or, an enforcement scenario, the overarching commercial understanding of the deal, that is entirely secondary to the documented perimeter of the pledge.
Right. The law doesn't care about what you meant to do.
Exactly. A security package is only as robust as its legally defined obligations. I mean, if the drafting lacks discipline, the legal protection simply is not there.
Yeah, and I think anyone who has worked in transaction management has felt that late-night pressure before a closing. Where you're just staring at a 300-page facility agreement, wondering if the collateral clause actually captures every single side letter, every hedging arrangement.
Oh, absolutely. It's a huge source of anxiety.
So, okay, let's unpack this. Let's look at the statutory foundation that governs this. Our primary objective today is understanding exactly how the Secured Obligations Clause defines the precise perimeter of a Luxembourg financial collateral pledge, specifically under the law of 5 August 2005.
Right, the 2005 law.
Yeah. So before we dissect those structural mechanics, let's establish the baseline. What are the core substantive takeaways that govern this whole framework?
Well, there are really 3 concrete must-knows to anchor our discussion here. First, a pledge strictly secures the relevant financial obligations that are precisely defined in the transaction documents.
Right.
It absolutely does not secure some vague, general, unwritten commercial intention. That's point 1.
Okay, got it. And the second?
Second, Luxembourg law provides a highly robust framework that expressly allows security for future, contingent, prospective, third-party, and even class-based obligations. And it does this without requiring constant redrafting.
Which is incredibly useful.
It is. And third, operational alignment is the ultimate discipline here.
Yeah.
The secured obligations, the collateral, the parties, the enforcement triggers, all of it must function as one legally coherent system across the entire suite of deal documents.
Right. I want to examine that second point of yours regarding that broad statutory framework. Because, if we aren't careful, drafting for future or contingent obligations can sometimes introduce ambiguity.
Oh, for sure.
And as counsel, we know that ambiguity is the absolute enemy of enforcement. So how does Luxembourg law mechanically support such a wide perimeter, allowing for obligations that might not even exist at closing without compromising legal certainty?
Well, that is the central structural question of the 2005 law. To understand how Luxembourg achieves that certainty without introducing vulnerability, we have to systematically examine the parameters of the framework.
Okay, so where do we start?
We need to evaluate the specific actors involved, right? Then the strict definition of the obligations, the scope of the collateral, and the transactional timing. So let's start with the actors. This framework specifically applies to financial sector professionals.
And that's not just a casual everyday description, right? That is a specifically defined statutory category. I assume the law deliberately limits this optimal framework to highly sophisticated entities to ensure systemic stability.
Precisely. It encompasses a very comprehensive ecosystem of professional market participants. So we're talking about credit institutions, investment firms, management companies, undertakings for collective investment.
Right, securitization undertakings too, right?
Exactly. Securitization undertakings, pension funds, insurance and reinsurance undertakings, as well as payment or electronic money institutions.
That's quite a list.
It is. By strictly defining these actors, the law ensures that this highly efficient, fast enforcement framework operates strictly among sophisticated entities that truly understand the legal and financial ramifications of the agreements they're executing.
Right, which means we're dealing with parties who actually possess the operational capacity to manage complex credit risk. But, even if we have these highly sophisticated actors, they still can't just pledge assets for absolutely any random commercial liability, can they?
No, definitely not.
Right. The law puts a strict boundary around what actually counts as a securable obligation, which brings us to the operational core. What exactly does this pledge secure?
So under Article 1, Paragraph 10 of the Law of 5, August 2005, relevant financial obligations are very strictly defined. The statutory test requires that the obligations give a right to cash settlement, or a right to the delivery of financial instruments, or a right to the assets underlying such financial instruments. If the obligation fits within those precise parameters, then it constitutes a relevant financial obligation capable of being secured under this specific regime.
That distinction is just vital. I mean, it's not just about owing a generic duty to perform a service. It is fundamentally tied to cash, financial instruments, or the underlying assets.
Exactly.
Now, looking at the scope of where this applies, the Law of 5, August 2005, governs a really comprehensive toolkit. We're looking at pledge agreements, title transfer collateral arrangements, repurchase agreements, and fiduciary transfers.
Yeah, and the collateral itself is equally comprehensive. It encompasses shares, fund units, bonds, debt instruments, and related claims.
It's an incredibly versatile toolkit, but I imagine its versatility relies on strict adherence to those statutory definitions we just talked about.
Oh, entirely. The moment you attempt to use the 2005 law framework for an obligation or an asset class that falls outside those definitions, you lose the robust protections.
Right.
Particularly the protections against standard insolvency proceedings, which is really what the law provides and why everyone uses it.
So, if you're listening to this and mapping out your current transactions, you might be wondering about the timing. Are there specific regulatory deadlines forcing parties to update their secured obligations clauses immediately? Like, when does this legal verification actually need to happen?
Well, the timing here is purely transactional. It's not driven by some arbitrary calendar deadline. Legal checks must occur at specific deal milestones.
Such as?
So every single time there is a new pledge, an amendment to the main facility, a refinancing event, an accession of a new obligor, a formal security confirmation, or, crucially, a pre-enforcement review.
Right, you have to test it.
Yes, you must test whether the secured obligations clause still perfectly aligns with the live transaction documents. The timeline is entirely dictated by the life cycle and the structural shifts of the deal itself.
Let's ground this in the broader European macro-level objective for a second. The entire design of this financial collateral framework is aimed at reducing loss risk for lenders, right? And supporting secured financial transactions across the market.
Absolutely.
The ultimate product of this legislation is absolute legal certainty, which ultimately lowers the cost of credit and facilitates cross-border capital flows.
Exactly. And that certainty brings us directly back to the mechanics of Article 1, Paragraph 10. What's fascinating here is how the law expressly states that present, future, actual, contingent, or prospective obligations do not require specific itemized descriptions to be valid.
Oh, wow. So you don't have to list every single thing out.
Right. The statute itself provides the structural capacity to capture, say, a revolving credit facility, where the exact exposure fluctuates daily. The law also explicitly permits securing obligations owed by someone other than the collateral provider,
right,
as well as obligations of a specified class or kind arising from time to time.
That statutory capacity is incredibly powerful. I mean, it means you don't need to execute a brand new pledge agreement every single time a borrower draws down a revolving facility.
Yeah, that would be an operational nightmare.
Right. However, while the law doesn't strictly require specific itemized descriptions for those future or contingent obligations, real-world execution absolutely demands precision. Statutory breadth is not a substitute for disciplined drafting.
No, it is not.
Because if you just write all obligations without tying it specifically to defined finance documents, you just invite legal challenges. So how do practitioners actually implement this during live transactions to ensure they maintain that precise perimeter?
Well, this is where we transition from statutory theory to the actual operational playbook. The secured obligations clause simply cannot be drafted in isolation. It must be rigorously cross-checked against the entire suite of transaction documents.
Yeah, step by step.
Step by step. That means verifying alignment with the facility agreement, any executed side letters, the hedging documents, the accession mechanics, the security agent wording, and the custody or account control arrangements.
That's a lot of cross-referencing.
It is, but if the main facility agreement defines secured liabilities one way and your pledge agreement defines them slightly differently, you've instantly created a major point of legal friction.
Let's examine exactly how that friction manifests in practice, because we often see initial drafts where practitioners want to secure the principal, the interest, default interest, various administrative fees, indemnities, break costs, and maybe potential future hedging liability.
It is. It's a highly complex scope of exposure.
Yeah, and the immediate temptation for a draftsperson is to use what we call the kitchen sink approach. They attempt to manually list every single conceivable liability directly in the pledge agreement, purely for comfort. They assume that listing 30 specific items provides maximum legal protection.
Yeah, and I firmly advise against that approach.
Yeah.
And here is the precise legal mechanism as to why it fails. Kitchen sink drafting creates significant legal and operational risk through internal inconsistency.
Right.
The true legal aim of the secured obligations clause is to prevent accidental narrowing or any gap between the credit exposure and the collateral support.
Okay, so give me an example of how that goes wrong.
Sure. Suppose you draft a clause that manually lists 30 specific items, including principal, interest, and standard indemnities. However, you fail to specifically list break costs arising from a newly executed ISDA master agreement for hedging purposes.
Walk me through exactly what happens when a liquidator challenges that specific drafting gap during an insolvency proceeding.
Right. So if the borrower enters insolvency, the liquidator's primary duty is to maximize the bankruptcy estate for unsecured creditors. So they will scrutinize the pledge agreement. By manually listing 30 specific items but omitting the specific hedging break costs, you have inadvertently applied the principle of specific inclusion and implied exclusion.
Wow.
Yeah. The liquidator will successfully argue that because you were so specific about what was included, the omission of the hedging liability must have been intentional. Consequently, that specific hedging exposure is deemed unsecured.
So, by trying to be exhaustively specific just for comfort, the draftsperson actually narrowed the scope of the security and lost the collateral backing for a highly volatile exposure. That is a devastating operational failure.
Exactly. It happens more often than you'd think. Instead of the kitchen sink approach, the defined perimeter must be sufficiently disciplined.
Right.
The standard, highly secure approach is to use a specific incorporation by reference. The pledge should secure all obligations defined as secured liabilities within the main facility agreement.
Right, linking them directly.
Yes, ensuring that as the facility agreement is amended or as new hedging documents are formally designated as finance documents, the pledge mechanically captures them without any internal contradiction.
That perfectly illustrates why the operational cost of establishing this disciplined perimeter is strictly driven by bespoke legal drafting and meticulous transaction management. Because this requires localized legal analysis of the specific live deal documents, there are no generic fixed administrative fees applicable here.
No, not at all.
The investment is entirely in the legal precision of the draft.
Correct. The security package is a highly customized legal mechanism. You simply cannot rely on boilerplate templates without verifying the specific cross-references to the current transaction.
Absolutely. So drafting requires that sharp, localized focus on the present deal documents.
Yeah.
But as regulatory counsel, you also must maintain a clear view of the surrounding regulatory environment, because your deal doesn't exist in a vacuum.
No, it certainly doesn't.
Let's shift our focus to the broader market context right now. Secondary industry commentary consistently highlights Luxembourg as a premier fund finance jurisdiction. And that's heavily driven by the legal certainty of the Law of 5, August 2005, for pledges over accounts, receivables, and partnership interests.
Yeah, that legal certainty is the major draw.
But looking beyond the collateral framework itself, what is the current regulatory pulse at the CSSF that practitioners need to integrate into their operational planning right now?
Well, there are three specific regulatory updates currently highlighted by the CSSF that practitioners managing cross-border transactions really must integrate. First, the CSSF has drawn attention to the publication of the Luxembourg Law of 5 May 2026.
Okay, and what does that cover?
This law transposes the Capital Requirements Directive 6, or CRD 6, and Directive EU 224299. Crucially, it amends the Luxembourg Law of 5 April 1993 on the financial sector,
Right.
establishing a specific transitional period for third country branches and third country banking services.
Let's pause on that because that is a fundamental structural update for cross-border banking operations. If you're structuring a deal where a non-EU bank, a third country entity, is acting as a lender or security agent in Luxembourg, this transposition directly impacts their regulatory capacity to operate.
It does. It forces a structural review of exactly how third country banking services are delivered and licensed.
What's the second update?
The second major update is that the CSSF has launched a complementary T+1 readiness survey.
The T+1 shift.
Yes. And third, the CSSF is actively highlighting the European Commission's report on the adequacy of the money market funds regulation. This specific focus includes operational guidance regarding wrinkly liquid asset benchmarks and overall liquidity resilience.
If we synthesize those updates, it becomes immediately clear why keeping your collateral clauses absolutely airtight is critical right now. The underlying operational and banking regulations are shifting simultaneously.
Exactly.
Let's look at the shift to a T+1 or one-day settlement cycle. If the market standard for settling securities trades shrinks to a single day, your operational window during an enforcement scenario shrinks right along with it.
That is the exact mechanical implication. In an enforcement scenario, if you appropriate pledged shares, the legal transfer must be executed cleanly and rapidly.
Right.
If there is any legal ambiguity regarding the secured obligations clause, say, if the borrower disputes whether a specific fee is actually secured, that ambiguity immediately halts the transfer process.
And under T+1, you don't have time for that.
Exactly. Under a T+1 cycle, you simply do not have the operational luxury of a multi-day window to argue over legal interpretations before a settlement failure occurs. The security package must be legally flawless so it can execute instantly.
Which means your security package cannot be the point of failure when liquidity resilience is being tested. Which prompts us to look at the hard deadlines ahead for these regulatory shifts.
Yeah.
What are the confirmed, strictly scheduled milestones?
Right. Sticking strictly to officially scheduled dates here without any speculation on future policy. First, the CSSF Complementary T+1 Readiness Surveys close very soon on 9 June 2026.
9 June 2026.
Second, the CRD-ZI transitional provisions for third country branches and the new third country regime for banking services apply formally from 11 January 2027.
11 January 2027. Got it.
And third, the amended Central Securities Depositories Regulation transition to T+1 is officially set for 11 October 2027.
So we really have a clear operational timeline here. With these structural market changes rapidly approaching, mastering the day-to-day execution of secured transactions is simply non-negotiable. Your foundational drafting must be flawless to withstand the accelerated operational pace.
It really must.
Let's bring this entire discussion back to the drafting table, with a scenario-to-execution narrative to consolidate our mastery of the subject. Suppose you receive a standard instruction from a client. Prepare a Luxembourg pledge securing our new cross-border financing. On the surface, that sounds like a routine administrative task.
The instruction always sounds simple. But true execution requires ensuring that the Secured Obligations Clause captures the exact intended exposure without creating a single point of ambiguity.
Right.
It requires a meticulous alignment process. You must align the loan documents, the obligor structure, the collateral description, the beneficiaries, and the enforcement triggers.
For example, if the primary facility agreement allows for a future accession of a new obligor, say, a new subsidiary joining the group structure in 6 months, how must the pledge handle that mechanically?
The pledge must mechanically recognize and secure that future obligation from day one. The drafting must incorporate the accession mechanism defined in the facility agreement so that when the new obligor signs the accession letter, the existing Luxembourg pledge automatically encompasses those new liabilities.
Without needing a total rewrite.
Exactly, without requiring a fundamental, costly restructuring of the entire security package.
It all comes back to systemic coherence.
Yeah.
The documents must communicate with each other flawlessly.
Exactly. If we connect all of these elements to the bigger picture, the core mastery insight for practitioners is really this. The pledge must be treated as the mechanical hinge between credit risk, collateral control, and enforcement execution.
Mechanical hinge. I like that.
Right. The secured obligations clause must be drafted broad, where the 2005 law permits breadth, such as capturing future revolving drawdowns, but highly precise, where execution requires precision, such as specifically cross-referencing the exact finance documents.
And most importantly,
it must be immediately usable without the need for last-minute legal reconstruction when an enforcement event actually occurs.
broad where permitted, highly precise where required. That is the fundamental drafting discipline of the Law of 5 August 2005. You have to leverage the statutory power without falling into the trap of internal inconsistency.
That's exactly right.
To conclude this substantive class, we arrive at this defining objective statement. Luxembourg is especially relevant because its financial collateral framework is expertly built for cross-border financial assets, fund interests, claims, custody accounts, and professional market participants, making disciplined drafting commercially decisive. The framework provides the tools, but the practitioner must provide the precision.
I couldn't agree more.
Before we close, I want you to consider that singular moment of translation we discussed at the very beginning of this session, that exact moment when commercial intent must become hard, enforceable legal security. As regulatory and operational landscapes shift toward faster settlement cycles and stricter third-country banking rules, the margin for drafting error is disappearing. Ensure your secured obligations clause is the strongest link in that translation, not the weakest point of failure. Follow on Apple Podcasts, Spotify, or wherever you get your podcasts. Subscribe to Bertrand Mariaux and Rigor Media on YouTube. Connect with Bertrand on LinkedIn at bertrandmariaux.com. All links in the show notes. This was the Luxembourg Fundcast.